Hello, everybody, and welcome. Today, my guest is Dr. Christian Funke. Christian is Managing Director and co-founder of German-based Source for Alpha Asset Management Company. Welcome, Christian.
Thank you. Hi, Thomas.
Christian, today we want to discuss recent developments in the US and perspectives for US equities. So the US has a new government. What does this mean for the US economy and especially for US equity?
Well, we're expecting a big change with the change from Donald Trump to Joe Biden. We have the inauguration, and the incoming administration will provide a completely different policy. We'll have a lowering of uncertainty. We will have a lot more predictability, meaning lowering of uncertainty will be very positive for the economic outlook and for the expected recovery post the COVID crisis and post the current recession. So we're expecting, let's call it a lot calmer waters in future, especially given predictability. As everyone knows, investors hate uncertainty. And I think the storming of the Capitol has showed that Donald Trump was the epitome of uncertainty at the end of his presidency. So we're looking forward to calmer times.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. So you name it, the US particularly has been hit very hard by COVID-19 and the crisis is still not over yet. So how do you deal as a portfolio manager with this high level of uncertainty in the US equity market?
Well, currently, indeed, uncertainty is still quite high if you compare to the pre-COVID period. We're currently looking at volatility in the market. If you measure it by the stock market volatility index, the VIX, that's currently reading about in the 20s, low 20s. But it is low compared to before. If we go back to the height of the crisis, we had a reading in the top of over 80, or in October, shortly before the election, we had VIX values around 40% volatility, meaning we have seen volatility coming down, and this is what we're going to be seeing in the future and expecting in the future, calming. Therefore, we're advising people to position portfolios to profit from lowering of uncertainty, lowering of volatility, and buy stocks that will profit from calmer waters, to say it.
So you are managing a rule-based equity strategy. So this is really special for your company. How exactly does it work, and why is it superior versus traditionally managed US equity strategies?
Well, what we do as a systematic or a quantitative asset manager is that we look at various factors in selecting equity positions. Those are classic factors. For example, there's value, there is momentum, or there's risk. Those are factors that play a role in selecting stocks. But what we do differently compared to maybe traditional, let's call it traditional equity strategy approaches, is that we don't use a static factor approach. We actually looking at the dynamic factors, meaning depending on what type of market environment we're in, we will weight and select stocks according to different factors. I'll give you an example. We're looking at, or the main thing we're looking at is something that's called the price of risk. This price of risk determines whether we are in a market state that is normal and calm, or whether it's heightened and aggravated and a problematic time. And if the price of risk is high, if we're in a highly uncertain environment, COVID-19 is a prime example, March 2020, that is high price of risk. That's when it's advisable to invest counter-cyclically into stocks that have been beaten down, that will recover, that will profit from a recovery and a lowering of volatility. So I would say the key differentiating factor is that dynamic approach to stock selection factors.
So during the COVID-19 crisis, especially in the US, earnings of most listed companies have come down, and this means with rising stock prices, also valuations came up. So what's your take on the current valuation level of US equity?
It's obviously very clear that valuation market-wide are very high, but it's also very clear that the dispersion in valuations is extremely high compared to historical averages. So if you look at certain things and compare them to the past, it very obviously meets the eye that there is a big difference compared to other times. For example, the top 10 weight of the top 10 stocks in the US stock market are almost 30% of the total market capitalization. This is at the top, the highest that's been ever. The average over the whole historic period is about 20%. So there's a high concentration, and those top stocks, the top 10, are also very expensive. So this dispersion is that we have a small part of the market. It's large in market capitalization, but small in number, that is very expensive, very highly priced. And those stocks are top companies. I mean, name Apple or Amazon. Those are top companies that have a huge market capitalization, 2.5 billion to spell it, but they will have to warrant future expectations in terms of their cash flows to actually be worth 2.5 billion. That is the size of the German economy, for example. So there's a huge expectation, and those expectations will have to be met. So we would say we have to be careful about the level of valuations in certain segments of the market and the dispersion of valuation. That is a sign that has to be considered in any portfolio that invests in US equities.
So you already named it. 2020 was a year of technology stocks, and if you have a closer look at the S&P 500, for example, majority of the performance came from technology stock. What role do stocks like the FANGs, Facebook, Amazon, Netflix, Google, and so on play in your portfolio currently?
Well, it's that's one thing that is very clear from the fund performance. It may be that people expect that those stocks have a high role because we've outperformed the S&P 500 over the last 2 years, a period where growth stocks were quite the top, the best performance segment in the market, but actually they play no role at all. So we do not have or did not have over those 2 years any position in those stocks. We've achieved that outperformance without holding them because there are other segments in the market that can be outperforming the S&P 500 and that we're expecting actually to continue outperforming this year, because there's other factors that will maybe play a role 2021 compared to 2020. 2020 was the influence of COVID, digital growth companies. We've talked about that a lot. But now we have a different period. We have the quantitative easing post-COVID. We have a normalization since November 9, 2020. We have the prospect of immunization. So we know that eventually we will have normal times again. And this is a good time for value stocks that should be profiting from economic recovery in the near term and from quantitative easing. So those are the stocks that we have been able to profit from in the last years, and that we expect to deliver good performance over 2021 as well.
This was Dr. Christian Funke from Source for Alpha. Thank you, Christian, very much for sharing your views and the interview.
Thank you, Thomas.